Despite rising interest rates, our next guest is bullish on the housing market. Neil Bader is a mortgage broker with Skyscraper Mortgage Company. And Neil, welcome. Thanks for joining us. You are bullish, and yet we have seen the long bond really go up as of late in the last year, and even in the last couple of weeks it's gone up even higher. Should home buyers then wait to refinance, or should they lock in what they have?
Well, in fact, what we're talking about, being bullish about the market itself, interest rates, of course, are higher. There's no question. We're looking at higher rates, and in fact, the real benchmark that people have been talking about is that loans under $240,000 for the first time in a long time are over 8%. But what's important to realize is that those are fixed-rate loans, and of course, there are an array of adjustable-rate products that are still, available at very low rates, still maybe even in the high 6s or low 7s, and there is so much pent-up demand nationally for housing that, in fact, I don't think that the little difference of 0.5% or 3/4, maybe even long-term a full percent, will really have that much of effect on the real estate market.
In other words, particularly in places like New York City, where the wealth effect of the stock market really does seem to be taking hold. In fact, it seems that nothing's going to stop them from buying a home.
Well, yes and no. In fact, if we really want to keep our eye on the ball, and it is a regional thing in a sense, is it's not so much the bond market that's really going to tank the real estate market here, but it could, in fact, be the stock market. If, in fact, the stock market reacts badly because we perceive to have higher interest rates, and that, in fact, brings the stock market down, that especially regionally in places like New York, where a lot of people are really tied to the stock market, that could have more of an effect than the actual interest rates themselves.
Right, the money in your pocket versus what you're going to be financing or refinancing for. Let's talk about some other areas of the country. What trends should we be looking out for elsewhere in the country?
Well, I actually think in the rest of the nation, it's probably a much longer-term trend. Well, you're really going to see the biggest difference now because of the higher interest rates is in new construction starts, because developers tend to look a year down the road, a year and a half, because that's when the projects are going to be finished.
Your advice then really is to not to wait out this market.
No, I think that long-term we're probably going to see some higher interest rates. Ironically, what usually happens right about the time of a Fed increase is that the market already anticipates that we get our run-up right now, and in fact, you probably will see slightly lower interest rates right about the time that the Fed, in fact, raises the interest rates. But I think that if I'm a consumer and I'm looking down the road, I would expect flat prices, no reason not to buy now. Get in, lock in your rate, and do your deal.
All right, so also if you're within 2 years of your adjustable expiring, any different advice?
Well, that's the big thing. I mean, we all know, or a lot of people know, that the refi market is basically dead. I mean, if you're a fixed-rate borrower and you want to refinance, if you haven't done it already, then you're probably in trouble. But there is really a built-in market. A lot of people in the last 10 years have been taking loans which are not fixed for the entire 30-year period. They're fixed for the first 5 years or first 7 years. And when those loans adjust, although they had very attractive teaser rates in the beginning, those are going to jump up. And if you are, let's say, 2 years out, so if you're in the 3rd year of a 5-year loan or the 5th year of a 7-year loan, now is probably a good time to think about locking that in.
All right. Good advice coming from Neil Bader. Thanks very much.
You're welcome.